A mom or a dad is going to sit down at the kitchen table, look at her car insurance bill, homeowner's insurance bill, or maybe even renter's insurance, add them up, and decide something has to go. And what thing has to go? It's not going to be the insurance. That same month, the insurance company will report some of the best profits in its history. 10 CEOs of the insurance companies will take home over $130 million in a single year, and State Farm, the company with the friendly neighbor jingle, owns 4 private jets. 4. Not to mention is the lead sponsor of 2 different stadiums, one of them here in my Arizona. And when this mom or dad calls to find out why her premium went up 50%, he or she will get the same answer. Costs are rising. Climate change, inflations. Lawyers like me. I'm a personal injury attorney, and I file insurance claims against these companies every single day. And I have seen what they pay out versus what they take in. Today, I'm going to show you, with the industry's own numbers, why that answer is mostly bull. Stick around, because at the end, I'll show you a simple rule that would hand American families $150 billion a year back in their pockets. Real quick, so we're all speaking the same language. Everything in this video is about property and casualty insurance, P&C for short. That's your auto insurance, your homeowners or renters insurance, and for businesses, it's insurance like workers' comp or liability coverage. Here's the thing about P&C insurance. For most of us, it's not optional. Do you drive a car? Then your state will require insurance. Do you have a mortgage? The bank requires homeowners insurance. Do you pay rent? Then your landlord likely requires that you have renter's insurance. It's about as voluntary as a tax. And for over 100 years, the Supreme Court and policymakers actually treated it like one. That's why every state has an insurance commissioner whose literal job is to reject prices that are too high. And this tax is enormous. In 2024, Americans and American businesses paid over $1 trillion in P&C premiums, property and casualty. That's more than the entire US defense budget. It's about 10% of everything American consumers spend. So the question worth 10 minutes of your life is, are we getting a fair deal on the biggest bill nobody talks about? Now, when your premium goes up, the insurance company will bury you in reasons. Storms, inflation, repair costs, social inflation, which is a fancy code word for these trial attorneys, which, by the way, I'm happy to do it because the insurance companies are usually backing off what they are supposed to do under the policy. And you have no way to check if they're right. Except you do. There's a number that cuts through all the excuses, and it's called the loss ratio. Out of every dollar they collect from you, how much goes back out the door in actual claims? That's it. And here's why it's the perfect BS detector. It automatically adjusts for everything they blame. If hurricanes get worse and claims go up, fine. Premiums go up too, and the loss ratio stays the same. If car repairs are pricier, claims go up, premiums go up, but the ratio stays the same. If costs are truly driving prices, the ratio holds steady. The only way the loss ratio goes down is if they're charging more than the increase in what they are paying out. So what is it? In 2024, the property and casualty industry loss ratio was 61.8%. For every dollar you paid in, 62 cents came back out as claims. The other 38 cents? Advertising, agent commissions, overhead, and record profits. You ever notice all the commercials out there for your insurance? What's paying for those advertisements? What's paying for that Super Bowl ad? Your premium. And the one thing that's personal for me, paying adjusters and defense lawyers to fight people like my clients. And 2024 wasn't a fluke. The 5-year average is about 63 cents on the dollar, making the loss ratio a 63. Keep that number in your head, because next we're going to compare it to what insurance used to pay and what health insurance is legally required to pay. Spoiler, 62 cents is not normal. Their story is, we're barely surviving. Claims are exploding. We have no choice but to raise your rates. Claim 1, premiums just keep going up with costs. Between 2020 and 2024, property and casualty premiums rose almost 50, more than double the pace of inflation. Claim 2, climate change is forcing our hand on homeowners insurance. Here's the check on that. From 2020 to 2024, homeowners claims payouts rose 40%. That's a real increase. Climate change is real. Storms are real. The damage that happens from them is very real. But your prices rose by 52% over that same window. They didn't just pass along the cost, they marked it up, making a profit out of climate change. And California, the poster child of insurance crisis, has a story to tell. In 2024, the loss ratio for homeowners insurance in California was 47%. So remember that, for every dollar the insurance companies took in for homeowners insurance, they were paying 47 cents. Yet, State Farm was threatening to pull out of the state, while paying about 50 cents for every California homeowner's dollar it collected, blaming things like the wildfires and other climate-related issues. Now zoom out, because this used to be a very different industry. Back in the 80s and 90s, property and casualty insurers routinely returned more than 80 cents on the dollar, making the loss ratio at an 80%. Today, it's around 71 cents, even on the industry's own generous net measures, the numbers that they're giving us. And here's the kicker. Health insurance companies are legally required to pay out 80 to 85%, and they're still profitable. So where's the other 38 cents going? The industry's own filings break it down. In 2023, the insurance industry collected about $930 billion. $610 billion was paid in claims. Then $135 billion on selling, advertising. That's the get-go, the Super Bowl ads, the agent commissions. To sell you a product the law already requires you to buy. Tens of billions on reinsurance, insurance for the insurance companies, and $82 billion on something the industry politely calls cost containment. Let me translate what cost containment really means, because that's my day job. That's the adjusters trained to lowball you, the delay tactics, the defense firms hired to wear you down and get you to commit to an offer that is less than what you deserve. They spent nearly $90 billion a year of your premium money on this machinery to pay you less. And when customers push back, in 2025, people filed about 63,000 complaints with their state regulators over wrongful claim denials. And the regulators' records show only about 2,500 confirmed outcomes across all of them, roughly 4 in 100. Those are the odds you are going up against if you're by yourself. Now, I'm not telling you this to try and sell despair. I'm telling you this because I watch it from the inside every day, every week, on my own cases. The system is built so that fighting you is a line item expense, and business is good. In 2024, the industry's return on revenue hit 15.6%. roughly double its own typical profitability, and better than the average American corporation. Now here's the part that almost nobody outside the industry understands. And honestly, once you see it, you'll never unsee it. Everything I've shown you so far has to do with insurance's normal business. Money in, claims out, keep the difference. But that's not actually how insurance companies make their real money. Think about the timeline. You pay your premium today. Your claim, if you ever have one, gets paid out months or years from it. In between, they're holding your money. Billions of dollars in premiums pooled into a gigantic pile of cash. And what did they do with that gigantic pile of other people's cash? They invest it. In 2024, property and casualty insurers were sitting on about $1.13 trillion of investable capital built from your premiums. Their investment returns roughly doubled to $166 billion in 1 year. And here's the number that should change how you think about every rate increase forever. In 2024, the industry didn't even need underwriting to be profitable, but premiums came in so high that they cleared $25 billion in underwriting profit anyway. In other words, you paid them for the privilege of holding your money, and then they kept the investment returns on it also. The Vanderbilt researchers put it perfectly. Stop thinking of these companies as insurers. Think of them as investment funds that use an insurance business to raise capital from you, nearly compelling you because the law says you have to buy their product. Hedge fund has to pay interest on borrowed money. An insurance company gets paid to borrow yours. That's the business. The karate class money isn't covering hurricanes. It's seed capital. The money that you would normally spend to go out to eat is being used to do their next venture. Oh, is it hopeless? No. And this is why I wanted to make this video. We have already solved this exact problem once in plain sight. Since 2010, federal law required health insurers to spend at least 80% or 80 cents of every premium dollar on actual care. It's called the medical loss ratio floor. If they spend less, they legally have to mail you a rebate check. Maybe you've gotten one before. The industry screamed, then adapted, and health insurers are very much still in business and making a profit. Researchers at Vanderbilt have drafted the same type of rule for property and casualty insurance, an 80% floor, and 80 cents for every dollar loss ratio. Pay at least 80 cents of every dollar they collect, which, remember, is exactly what the industry itself was doing in the 80s and 90s, and give the rest back to the customers if it's less. The math? Had the rule been in force in 2024, American families and business would have kept about $150 billion every year, not from taxpayers, just from that fat. The $135 billion ad and commission machine, the private jets, the stadium naming rights, the record margins, the claims still get paid. The hurricanes still get covered. Your premium just stops funding Super Bowl commercials. Until that happens, 3 things you can do as of now. 1, shop your policy every single year. Their $135 billion selling machine works on people who don't compare. Loyalty is literally pricing you out of the game. Number 2, if a claim gets denied or lowballed, don't just take it. File a complaint with your state insurance commissioner in writing. Remember, 4% odds alone is exactly why documentation, and sometimes a lawyer, change the math for you. When I get involved, the file stops being handled by a lowball algorithm and starts being handled by someone doing risk assessment on me. Number 3, remember that your state insurance commissioner works for you. They have the legal power to reject excessive rates for 100 years. They respond to exactly one thing: voters. Voters who know the loss ratio exists, who know what it means. Next time somebody tells you that your premium went up because of a storm or fraud or greedy trial lawyers, ask them one question. Then why did the loss ratio go down? They can survive a hurricane. What they can't survive are customers who can read one number they don't advertise: the loss ratio. If this was worth your 10 minutes, share it with somebody whose premium has gone up. And I'll see you on the next one.